If you are retired and collecting Social Security, the IRS just made changes that could cost you thousands. Most retirees have no idea these 2026 tax updates even exist. I have spent over 30 years helping folks like you protect every dollar they earned. Today I am going to walk you through the exact IRS changes that could quietly shrink your retirement savings. The government does not send you a personal warning letter when tax rules shift against you. They expect you to figure it out on your own or pay the price at tax time. That is exactly how retirees end up overpaying by hundreds or even thousands of dollars every single year. I do not want that happening to you, so please stay with me for every single minute of this video. There is one hidden rule buried deep in the 2026 tax code that almost nobody is talking about. It could save some of you as much as $1,400 or more this year alone, but you will only benefit if you know it exists and take action before the deadline passes. I promise you, by the end of this video, you will know exactly what to do and when to do it. Let me set the stage so you understand why these changes matter so much right now. The IRS adjusts tax brackets, deductions, and thresholds every year based on inflation. According to the IRS and data from SSA.gov, the 2026 adjustments are significant for anyone over 60. These are not small tweaks. They are meaningful shifts that directly impact how much tax you owe. Here is the basic problem that catches most retirees off guard every single year. Your Social Security benefit went up thanks to the cost of living adjustment for 2026. But that COLA increase can push you into a higher tax bracket or trigger taxes on your benefits. Suddenly, the raise you thought you received disappears into Uncle Sam's pocket before you even see it. Think of it this way. And I love using simple pictures to explain complicated tax rules. Imagine you are filling a glass of water, and the glass represents your tax-free zone. Every dollar of income you add brings the water level closer to the rim of that glass. Once it spills over, the IRS starts taxing your Social Security benefits at rates that shock most people. The IRS uses something called combined income to decide if your Social Security gets taxed. Combined income is your adjusted gross income plus non-taxable interest plus half of your Social Security. If that number crosses certain thresholds, up to 85% of your benefits become taxable income. Those thresholds, $25,000 for singles and $32,000 for married filing jointly, have not changed since 1993. That is right, those numbers were set over 30 years ago, and Congress has never updated them. Back in 1993, the average Social Security benefit was around $674 a month. Today, the average benefit is over $1,900 a month, according to SSA.gov in 2025. More retirees than ever are crossing those thresholds and getting taxed on benefits that used to be completely tax-free. Now let us dig into the first major IRS change for 2026 that you absolutely need to understand. The IRS has adjusted the standard deduction for 2026, and this one directly helps you. For single filers, the standard deduction is projected to rise to approximately $15,700. For married filing jointly, it is expected to increase to around $31,400. If you are 65 or older, you get an additional standard deduction on top of that base amount. For 2026, that extra amount for seniors is projected at approximately $2,000 for single filers. For married couples filing jointly, where both spouses are 65 or older, each spouse gets roughly $1,600 extra. That means a married couple both over 65 could have a combined standard deduction near $34,600. This higher deduction is your first line of defense against the IRS taking more of your money. Every dollar of deduction reduces your taxable income by exactly $1, which means real savings. If you are in the 12% bracket, that extra deduction increase could save you around $150. It does not sound like a fortune, but combined with other strategies I will show you, it adds up fast. Here is where it gets really important, so please pay close attention to this next part. The IRS also adjusted the income tax brackets for 2026 to account for inflation from the prior year. The 10% bracket for single filers now covers income up to approximately $11,925. For married filing jointly, the 10% bracket extends to roughly $23,850. The 12% bracket for singles is projected to cover income from $11,926 to approximately $48,475. For married filing jointly, the 12% bracket runs up to roughly $96,950. These wider brackets mean you can earn slightly more before jumping to the next tax rate. For retirees living on fixed incomes, that breathing room can prevent an unexpected tax bill in April. Let me show you exactly what this means with a real example you can relate to. Say you are a single retiree named Margaret, who receives $22,000 a year in Social Security. Margaret also takes about $15,000 from her traditional IRA each year for living expenses. Her combined income puts her right at the edge of owing federal taxes on her Social Security benefits. Under the 2026 brackets and higher standard deduction, Margaret might owe approximately $240 less in federal taxes. That is $240 that stays in Margaret's bank account instead of going to Washington. Over 5 years, that is $1,200 she keeps by simply understanding how the new brackets work. Margaret did not have to do anything special except file her taxes correctly using the updated 2026 numbers. Now compare Margaret to her neighbor Bill, a married retiree filing jointly with his wife Susan. Bill and Susan have a combined Social Security income of $40,000 per year. They also withdraw $22,000 from their retirement accounts to cover their expenses and travel. Their combined income is high enough that up to 85% of their Social Security could be taxable. But here is the good news for Bill and Susan in 2026 with the updated tax brackets. Their taxable income after the larger standard deduction falls more comfortably within the 12% bracket. They could save roughly $380 compared to what they would have owed under 2025 rules. That $380 might cover 2 months of their Medicare Part B premium increase. The key takeaway from this first section is simple but powerful for your household budget. The 2026 standard deduction increase and wider tax brackets work in your favor if you know they exist. Do not assume your tax situation is the same as last year because these numbers change annually. Check the updated IRS brackets at irs.gov before you file or before your tax preparer does your return. I know we have covered a lot of numbers already, so take a breath with me here. But please do not stop watching now, because what I need to tell you next is worth every minute. The second major insight involves a trap that catches millions of retirees every single tax season. It has to do with how your retirement account withdrawals interact with your Social Security taxes in 2026. Stay with me, because what I am about to show you will surprise you and possibly save you real money. Most retirees pull money from their traditional IRA or 401k without thinking about the tax consequences. Every single dollar you withdraw from a traditional retirement account counts as ordinary taxable income. That withdrawal gets added to your combined income and can trigger taxes on your Social Security benefits. Here is the trap in plain English, so there is absolutely no confusion about what happens. You withdraw $10,000 from your traditional IRA to pay for a new roof on your house. That $10,000 gets added to your adjusted gross income on your tax return for the year. Suddenly, your combined income crosses the threshold, and the IRS taxes up to 85% of your Social Security. Let me put specific numbers on this so you can see exactly how painful this trap really is. Say your Social Security benefit is $24,000 a year and you have no other income. Half of your Social Security is $12,000, which is well below the $25,000 threshold for singles. In this scenario, you owe zero federal tax on your Social Security benefits, which is exactly how it should be. Now you withdraw that $10,000 from your IRA for the roof repair you desperately need. Your combined income jumps to $22,000, which is $12,000 plus the $10,000 IRA withdrawal. You are still under the $25,000 threshold, so you might think you are safe and clear. But add in any interest income, even a small certificate of deposit earning $400, and you are over. Once you cross $25,000 in combined income as a single filer, up to 50% of your Social Security becomes taxable. Cross $34,000 and up to 85% of your Social Security becomes taxable income. On a $24,000 Social Security benefit, 85% means $20,400 added to your taxable income. At the 12% bracket, that is an extra $2,448 in federal taxes you now owe. That $10,000 IRA withdrawal for your roof just cost you an additional $2,400 in taxes. Your actual cost for that roof was not $10,000. It was effectively $12,448. Most retirees never connect these dots until they see the tax bill and wonder what went wrong. This is the silent trap that eats away at retirement savings year after year after year. So what is the solution to this IRA withdrawal trap in the 2026 tax year and beyond? One powerful strategy is called Roth conversion, and the 2026 tax bracket changes make it even more attractive. A Roth conversion means you move money from your traditional IRA into a Roth IRA and pay taxes now. Once money is in a Roth IRA, future withdrawals are completely tax-free and do not count toward combined income. The 2026 wider tax brackets give you more room to do partial Roth conversions at the 12% rate. For a single retiree, you might convert up to the top of the 12% bracket without jumping to 22%. That means you could convert several $1,000s, pay only 12 cents per dollar in tax, and lock in tax-free growth. Every dollar you convert now is a dollar that will never trigger taxes on your Social Security benefits later. Let me walk you through a specific Roth conversion example using 2026 projected numbers from the IRS. Suppose you are single, 67 years old, with $18,000 in Social Security and a large traditional IRA. After your standard deduction of roughly $17,700, you have very little taxable income. You could convert approximately $28,000 to a Roth IRA and stay entirely within the 12% bracket. The tax on that $28,000 conversion would be about $3,360 at 12%. That sounds like a lot of money to pay right now, and I completely understand the hesitation. But consider this, that $28,000 will now grow tax-free in your Roth for the rest of your life. When you withdraw it later, it will not add a single penny to your combined income or trigger Social Security taxes. Compare that to leaving the money in your traditional IRA and withdrawing it in a future year. If you withdraw $28,000 in a year when you have other income, you could easily owe 22% or more. Plus, that withdrawal could push 85% of your Social Security into taxable territory, as I just explained. You would end up paying far more than $3,360 in total tax impact over time. Now here is the part most seniors never hear about, and it could change your entire tax strategy. The IRS has a specific rule about qualified charitable distributions, known as QCDs, that retirees should absolutely use. If you are 70 and a half or older, you can donate up to $105,000 directly from your IRA to charity. That donation counts toward your required minimum distribution, but does not count as taxable income at all. Let me say that again, because it is that important for your 2026 tax planning strategy. A qualified charitable distribution satisfies your required minimum distribution without adding a single dollar to your taxable income. It does not increase your combined income, so it does not trigger taxes on your Social Security benefits either. If you are already giving to your church or a charity, this is one of the smartest tax moves available. Here is a real-world example of how QCDs work for a married retired couple in 2026. Tom and Linda are both 73 and have to take required minimum distributions from their traditional IRAs. Tom's RMD is $8,000 and Linda's RMD is $6,000, totaling $14,000 combined. They normally donate $5,000 a year to their church and local food bank from their checking account. Instead of taking their full RMDs as cash and donating separately from their checking account after taxes, they use QCDs. Tom directs $5,000 from his IRA directly to their church and the food bank as a QCD. That $5,000 never shows up as income on their tax return, reducing their adjusted gross income by $5,000. At the 12% bracket, that saves them $600 in federal taxes right there. But the savings do not stop at $600 because there is a cascading tax effect most people miss. That $5,000 reduction in adjusted gross income also lowers their combined income for Social Security taxation. It could keep them below the threshold where 85% of their benefits become taxable. The total tax savings from one simple QCD could easily reach $1,000 or more for Tom and Linda. Now, I want to make sure you understand the required minimum distribution changes coming in 2026 as well. Under the Secure Act 2.0, the age for required minimum distributions increased to 73 starting in 2023. It is scheduled to increase again to 75 starting in 2033. But for 2026, the age remains 73. If you turn 73 in 2026, you must take your first RMD by April 1st of 2027 at the very latest. Here is a warning about that April 1st deadline that trips up first-time RMD takers every single year. If you delay your first RMD to April of 2027, you still must take your regular 2027 RMD by December of 2027. That means 2 RMDs in one calendar year, which could double your taxable income for that year alone. 2 large distributions in 1 year can push you into a higher bracket and trigger maximum Social Security taxation. The smarter move for most retirees turning 73 in 2026 is to take the first RMD before December 31st. By taking it in 2026, instead of waiting until April 2027, you spread the income across 2 separate tax years. This keeps your taxable income lower in each individual year rather than spiking it all at once. It is a simple timing decision that could save you anywhere from $500 to over $2,000 depending on your RMD size. Let me give you a concrete example with dollar amounts so you can see this timing strategy clearly. Patricia turned 73 in June of 2026 and has $400,000 in her traditional IRA. Her RMD for 2026, calculated using the IRS Uniform Lifetime Table, is approximately $15,060. If she waits until March 2027 to take it, she will also owe her 2027 RMD of about $15,600 in that same year. That means Patricia would have roughly $30,660 in IRA income hitting her 2027 tax return. Combined with her Social Security of $21,000, her combined income would easily exceed $34,000. The IRS would tax 85% of her Social Security, adding about $17,850 to her taxable income. Her total federal tax bill for 2027 could be nearly $5,800 just from that one timing mistake. If Patricia instead takes her first RMD in December 2026, she spreads the income across 2 years. Her 2026 tax return shows $15,060 in IRA income, and her 2027 return shows $15,600. Neither year has a combined income spike large enough to trigger the maximum 85% Social Security taxation. Patricia could save approximately $1,900 in total federal taxes just by choosing when to take that first distribution. Now let us talk about a third major area that retirees need to watch carefully in 2026. The IRS rules around Medicare premium surcharges, known as IRMA, are directly tied to your tax return. IRMA stands for Income-Related Monthly Adjustment Amount, and it can dramatically increase your Medicare premiums. The Social Security Administration uses your tax return from 2 years ago to determine your 2026 IRMA bracket. That means your 2024 tax return, which you filed in early 2025, determines your 2026 Medicare premiums. If you had an unusually high income year in 2024, you could be paying hundreds more per month for Medicare in 2026. The first IRMATA tier for 2026 kicks in at a modified adjusted gross income above $106,000 for single filers. For married couples filing jointly, the first IRMATA threshold is approximately $212,000, according to CMS.gov. If you cross that first threshold, your 2026 Medicare Part B premium jumps by roughly $74 per month. That is an extra $888 a year just in Part B premium surcharges alone. Cross the second tier, and the surcharge increases to about $185 per month extra. At the highest IRMA tier, you could pay an additional $443 per month on top of the standard premium. Here is the connection most retirees miss between their IRA withdrawals and their Medicare premiums. That large IRA withdrawal or Roth conversion you did in 2024 could trigger IRMA surcharges on your 2026 Medicare premiums. So while the Roth conversion saves you future income taxes, it might temporarily increase your Medicare costs. This is why tax planning for retirees is like a chess game where every move affects 3 other pieces on the board. The good news is, the IRS and Social Security Administration allow you to appeal IRMA surcharges in certain situations. If you experienced a life-changing event like retirement, divorce, or death of a spouse, you can file SSA Form 44. This form asks Social Security to use your current year income instead of the income from 2 years ago. Many retirees qualify for this reduction and never file the form because they simply do not know it exists. Let me now reveal the hidden gem that I promised you at the beginning of this video today. There is a little-known IRS provision that allows retirees to claim a tax credit specifically designed for the elderly. It is called the Credit for the Elderly or the Disabled, and it is found on IRS Schedule R. This credit can reduce your federal tax bill by up to $750 for singles or $1,125 for married couples. To qualify for this credit in 2026, you must be 65 or older by the end of the tax year. Your adjusted gross income must be below $17,500 if you are single, or below $25,000 if married filing jointly. Your non-taxable Social Security and other non-taxable income must be below $5,000 for singles or $7,500 for married filing jointly. If you meet all these requirements, you could receive a direct reduction in the taxes you owe, not just a deduction. The reason almost nobody claims this credit is that the income limits are quite low and confusing. But there are retirees living primarily on Social Security with very small IRA withdrawals who absolutely qualify for this credit. If your total income is modest and you are over 65, ask your tax preparer specifically about Schedule R. You might be leaving hundreds of dollars on the table every single year simply because no one told you about it. Here is another hidden opportunity that the 2026 tax rules make available to qualifying retirees with low income. The Saver's Credit, formerly known as the Retirement Savings Contributions Credit, might apply if you are still contributing to retirement. While most retirees are not contributing, some who work part-time in retirement might be eligible for this credit. It can provide a tax credit of up to $1,000 for singles or $2,000 for married couples filing jointly. Additionally, retirees who are 65 or older and have out-of-pocket medical expenses should know about the medical deduction. For 2026, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. If your AGI is $30,000, any medical expenses above $2,250 are deductible. With the rising cost of dental work, hearing aids, and prescription drugs, many retirees easily cross this threshold and never claim it. Now let me give you your specific action steps so you can protect your money starting today. First, go to irs.gov and download the 2026 tax bracket tables so you know exactly where your income falls. Second, calculate your combined income to determine if your Social Security benefits will be taxed in 2026. Use this formula: your adjusted gross income plus non-taxable interest plus half your Social Security equals your combined income. Third, if you are 70 and a half or older and give to charity, call your IRA custodian about setting up qualified charitable distributions. The phone number for Fidelity is 800-343-3548. Vanguard is 800-662-7447. And Schwab is 800-435-4000. Fourth, if you turned 73 in 2026, decide whether to take your first RMD this year or delay until April 2027. As I explained, taking it this year almost always results in a lower total tax bill over both years combined. Fifth, if you received an IRMA surcharge notice and experienced a qualifying life-changing event, download SSA Form 44. You can find it at ssa.gov or call Social Security at 1-800-772-1213 to request a copy by mail. Sixth, ask your tax preparer about the credit for the elderly on Schedule R and the medical expense deduction. These are the two most commonly missed tax benefits for retirees and could save you hundreds of dollars. Let me wrap up today's video by reminding you of the single most important thing I shared. The IRS changes its rules every single year, and 2026 is no exception to that pattern. The retirees who save the most money are not the wealthiest. They are the ones who stay informed about the rules. Every dollar you save on taxes is a dollar that stays in your pocket to spend on the people and things you love. If this video helped you understand your 2026 tax situation even a little bit better, please hit that subscribe button. I release new videos every week specifically designed to help retirees like you protect and maximize your benefits. Next time, I am going to cover a Social Security strategy that could increase your lifetime benefits by tens of thousands of dollars. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with ssa.gov or medicare.gov.